My suspicion is that the surprise this coming year is that gold will do better than people think it is, because people have an expectation with regards to inflation that I think is unrealistically low. I think the problem that we have around, in particular, U.S. debt and deficits, and the interplay between interest rates, which are low, and the inflation rate, which is higher than people think it is very, very, very bullish to gold. Whether or not that plays out in 2025, or whether or not it takes the market longer to realize that, recognize that, I don't know.
Gold could outperform expectations in the coming year due to underestimated inflation and mounting U.S. debt concerns. The gap between low interest rates and higher than expected inflation creates a bullish environment for gold. Whether this plays out entirely in 2025 or takes longer for markets to recognize remains uncertain. Notably, gold is already outperforming the S&P 500 this year. RickRule, a well-renowned speaker and analyst, explains that decades of underinvestment in resource production, rising global demand, and geopolitical tensions, particularly between the U.S. and China, are shaping the outlook for industrial materials and gold. Emerging markets require raw materials for growth, potentially lowering capital costs for resource companies. Meanwhile, major economies like Japan, Korea, the U.S., and China are increasingly engaged in a geopolitical resource battle. Investors may need to reassess their strategies in this shifting landscape, including whether Canada remains a top-tier mining jurisdiction. All jurisdictions have challenges, and there are no truly good ones. In Canada, Alberta, Saskatchewan, and Quebec are preferable, while BC is seen as difficult, though First Nations land with pro-development leadership may be an exception. In the U.S., state policies matter more than federal leadership, with Trump-aligned states like Alaska, Wyoming, Nevada, and Texas being more favorable for resource investments. Mexico presents a mixed political message, with leadership signaling stricter regulations and recognizing the economic necessity of mining in certain regions. RickRule exposes that the Fed is cutting short-term rates, but long-term rates are rising, signaling that investors doubt the Fed's inflation forecasts. This suggests the Fed is losing control of the long end of the yield curve, similar to what happened in the Clinton years. Markets recognize that the Fed's rate cuts may be politically driven despite a strong economy, increasing risks rather than reducing them. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
Who leads what country? And I think 3 decades of underinvestment in productive capacity around many materials and increasing numbers of people bode well for other industrial materials. And going back to geopolitics, the emerging conflicts between, as an example, China and the United States, the need for raw materials to support industrial growth in frontier markets where they need to displace existing people like the European community in the U.S., means that perhaps the cost of capital for resource companies come down as industrial producers, OEM manufacturers, things like that, in places like Japan, places like Korea, places like the United States, places like China, participate in this global geopolitical game. You know, Kai, my opinion is very unpleasant with regards to that. I think every jurisdiction in the world is bad. I don't think there are any good ones. I believe that the government that's most dangerous is the one that's closest to you. I'm here in British Columbia. People in British Columbia, because they understand the risks here, think it's a great jurisdiction. I think it's a horrible jurisdiction. I've been treated better in Congo than I have in BC, or California for that matter, where I was from. So I think all the jurisdictions are lousy. Within Canada, my preference would be to be in Alberta, in Saskatchewan, or in Quebec, rather than other provinces. If I was going to be in BC, I'd want to be in Tahltan land. I'd want to be in First Nations land where the First Nations were intelligent and supportive of resource development. I think the U.S. regulatory climate is going to get a bit better, but remember that Trump doesn't control the individual states. So if you're looking to play the Trump game, look to play the Trump game in Alaska, look to play the Trump game in Wyoming, look to play the Trump game in Nevada, look to play the Trump game in Texas, and be very careful everywhere else. You know, he's not the boss. In jurisdictions that look really, really, really bad, like Mexico, understand that the bark is probably worse than the bite. She has been dialing back some of her statements. Yes, she is a dyed-in-the-wool commie. You know, she is. But she also understands that her party needs to get elected. And there are places in Mexico where, without mining, They're literally picking corn and picking beans. So what she has said is, to the extent that a mining project generates local support, local goodwill, are going to begin to control the process in Mexico. I happen to believe that's a lie, but it's a wonderful sounding word because that's the way it should be in Mexico. So politics, very, very, very mixed message. What interests me recently, and this has been a factor, is the fact that the Fed is cutting rates and the long-term rate has risen, which is to say that the Fed has lost control of the long end of the interest rate curve. Big investors are saying is that the Fed's estimates of inflation going forward are wrong. They understand that the Fed is trying to lower interest rates despite a strong economy for political purposes, but the risks to them are increasing rather than decreasing. So the Fed is lowering the short-term cost of funds, and the market is taking up the long-term cost of funds. That's extremely telling. The Fed wishes it wasn't true, but the Fed is beginning, as it did in the Clinton years, to lose control of the long end of the interest rate, and that's very interesting.
RickRule says long-term investors focus on value over years, not short-term price swings. Rising inflation suggests higher gold prices, but short-term stock declines don't matter if the long-term potential is strong. Interest rates don't impact investment decisions directly. What matters are economic signals, not short-term market flows. Despite market fluctuations, resource investments are driven by fundamental value and long-term upside. RickRule was once skeptical of ETFs, disliking the idea of paying fees to own stocks he wouldn't personally choose. However, he now sees their value for investors who want market exposure without deep research. While ETFs slightly underperform due to management fees, they offer convenience. He also believes investors tend to overtrade, citing a Fidelity study showing that the best-performing accounts over 10 years belong to deceased individuals who never traded. Debt is generally safer than equity due to liquidation preference, but Wall Street structured debt often favors issuers over investors. RickRule ensures stricter covenants when structuring debt for his portfolios. Challenging capital markets can create attractive debt opportunities, as seen in the 1980s oil collapse when high-yield convertible debentures were deeply undervalued. While he hasn't seen a similar chance yet, a severe market downturn could create one. Now, let's dive into the interview.
You trade stocks. I buy them for the 4 or 5 year context based on what I think they're worth. What the market tells me is that the gold price is going to go higher because inflation is going to go higher. It might be that there is less dumb money in the space as a consequence of a risk-on trade or a risk-off trade. And it might be that something that's a 45-cent stock becomes a 30-cent stock. I don't care much about that. I care about a 45-cent stock where I'm okay if it went to 30 because I think it's going to $4. So for me, I look at things very, very differently. The near-term cost of funds doesn't impact my decision at all, because I'm not smart enough to be a trader. I'm an old man, and if you take away most of my downside, you can have some of my upside. Particularly the upside is due to time. When I look at the interest rates, I'm looking at something very different. I'm looking at the economic signals, not the flow funds. You know, I used to be really, really, really negative on ETFs, despite the fact that I'm the largest shareholder of Sprott, which is an ETF sponsor. But I used to look at some of these indexes, and there'd be, if there were 35 companies in an index, there might be 20 that I wouldn't own with my own money. And the idea that I'd pay somebody a fee to own stocks I wouldn't own seemed inelegant. Then I recognized that most investors aren't willing to do as much work with me. And for them, they want the beta. They want to be in the market, but they want to be in a market in a way that allows them to spend time with their grandchildren, stuff like that. So I get it. I've come around there. I would rather see them in the market than see them not in the market for their own purposes, not for the market's purposes. So I'm more inclined towards ETF now than I used to be. Somebody who gets in an ETF needs to understand that they're going to slightly underperform the market beta because there's a management team, a management fee. But I'm okay with that. I think that people, even in ETFs, overtrade. The huge Fidelity Mutual Fund Group looked at their whole investor base, and they sliced it up by age, region, race, all kinds of things. And the component of their investor base that had the investment returns over 10 years, you know what they were? Dead people. Dead people. People who didn't trade at all, didn't chase the latest fad. They cut their customer base by every possible criterion. And the group that performed the best over time were dead people. People need to remember that the worst piece of debt is better than the best piece of equity on any individual balance sheet. You're ahead of them. in terms of liquidation preference.
Yes.
The difficulty with Wall Street generated debt is that the Wall Street firms structure the debt to favor the issuer, because that's who pays them the commission. When I structure a piece of debt on behalf of my portfolio, on behalf of Orion, on behalf of Sprott, the covenants and conditions are very, very, very different. I look at the covenants on debt that I see that's structured by Wall Street, and it basically says that the issuer repays me if and as when convenient for them. That doesn't work for me.
No.
When capital is tough to raise, sometimes the conditions and restrictions become stricter. And in those circumstances, I'm attracted to it. I remember back to the decade of the 80s when the oil and gas business fell apart. And I was able to buy convertible debentures that had strict covenants. They had been written when interest rates were 12 and 15%, so they had 12% cover rates, and they were selling at 30, which meant that my running yield was at 25% and my yield to maturity was 40%, and they were good covenants. I mean, that was when I made my name in the bond business. You know, I noticed that incongruity. I called up a friend of mine named Doug Casey. I took him through the case, and he wrote one of the best newsletters ever written that month on those bonds, and made a fortune for his subscribers, made a fortune for me. It was really, truly circumstance. I haven't seen that circumstance yet. If we have a cataclysmically bad market at some point in time.
In a rapidly evolving economic and geopolitical landscape, inflation, interest rates, and global tensions influence gold, resource investments, and debt markets. While long-term investors focus on value over time, market fluctuations and policy shifts create challenges and opportunities. With the Fed losing control of long-term rates, what are the potential consequences for gold and other safe haven assets? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.